As you know, this is Fed Day, but it's not just any Fed Day. In a few hours, Fed Chief Ben Bernanke will make history when he gives his first press conference after the central bank's two-day policy meeting. What is he going to say? And what will the market reaction be? Which questions are reporters going to actually get answers to? Mike Pond, the Director of Interest Rate Strategy for Barclays Capital, joins us now. Mike, how much business is being put off because of today's press conference and decision coming down?
Well, the markets have certainly been on pins and needles over the past couple of days, and that has lowered trading volume somewhat.
Excuse me, sorry, I just got a catch in my throat. But when we hear the Fed chief speak today, I mean, what is it that could actually move the needle for you? You do, in fact, expect him to confirm QE2 ends in June, right? That's
right. So we actually expect no surprises. While the market is very focused on the chairman's press conference, we expect it to be much ado about nothing. Essentially, we do hear from the Fed chairman fairly often. He goes before Congress and speaks and is questioned there. He has held press conferences in the past, but it's just the timing coming right after the FOMC announcement that's different today. We don't expect the views to be any different than he's shared in the past, over the past couple of months. Nothing's really changed, but we are going to be listening quite closely on any signs of when the Fed is likely to start removing stimulative policies put in place.
Yeah, you say it's probably, being made a little bit too much of, yet the Fed chairman still felt he needed to do this. He still felt like there was a need in the marketplace for him to answer and clarify some things. What do you think has been most misunderstood about the Bernanke Fed?
No, I think that's the right approach to help the market understand in a bit more detail the short, fairly brief FOMC statement. So last August was a clear indication that the markets misinterpreted the FOMC statement as essentially taking the statement as the economy has slowed and we're not going to do anything about it. That's when they announced that they would be reinvesting mortgage and agency proceeds, keeping their balance sheet constant rather than increasing it further. The Jackson Hole speech by Bernanke at the end of August clarified that they would indeed take steps to add more stimulus if the economy slowed, and eventually they implemented QE2 as a result of a slowing economy. But again, there was a gap between the FOMC statement and when the chairman came out and clarified the market's perceptions.
Right.
What they want to do is tighten up that gap.
Well, there was that sort of creeping panic as we got closer to the exit from mortgage-backed securities market. This time around, the exit from QE2. What happens to the credit markets in June?
Well, the Fed thinks it benefits by being very transparent and gradual in its approach to monetary policy. So again, what they're trying to do is make it very clear that QE2 is indeed likely to end at the end of June, purchase their 600 and be done with it. We think they'll continue to reinvest mortgage and agency proceeds, so still be involved in the secondary market, but telegraphing QE2, the end of QE2 in advance, makes it less of a market mover when it actually happens.
Mm-hmm. What will the Fed chairman say about the inflation consumers are experiencing versus the inflation they don't seem to see at the central bank?
Again, the key word is transitory. They believe that the energy price increases, food price increases that are pushing up on headline inflation measures, which is hitting the consumer and slowing consumer growth to some extent. We think that the Fed, at least the central views on the Fed, coming from Chairman Bernanke, Vice Chair Yellen, and New York Fed President Dudley, is that these increases are transitory.
Right,
that they're
but then
not
this
likely
week,
to be persistent.
we got those USDA forecasts, we got the UN forecast that said, sure, up until now, you've got the prices going up for a lot of foodstuffs, the grains. Now it's going into the proteins, it's going into the meats. Maybe that means it isn't so transitory.
That's right. So food price increases are likely to be with us for several quarters because of increases in raw commodities. It takes a while for raw commodity price increases to work their way through the food system because as corn rises, that eventually eventually feeds through into, as you mentioned, proteins, because we feed cattle and other protein-producing animals corn. And so it takes a while to feed through into consumer prices. So we're likely to experience high food prices or high food inflation for quite a while here. So we think the Fed should be more focused on headline inflation measures rather than just core. We believe that the global demand pressures on core and or food and other commodities mean that this commodity story is structural rather than transitory.
Wow. We will listen in at 2 p.m. following up on that 12 decision. Thank you so much, Mike Pound.
Thanks, Margaret.